Welcome, everyone. Today, my guest is Managing Editor James Kleimann to talk about Homepoint shutting down and the misinformation that went viral recently about 40-year mortgages. First, here's a word from our sponsor. This is Sarah Wheeler, Editor-in-Chief at HW Media, talking with Matt Dowd, Vice President of Product Management at ICE Mortgage Technology, about mortgage automation. Matt, what challenges are customers facing around adoption?
I think the challenges lenders face with adoption are fairly consistent and evident, but the real question is how to solve the adoption question. So it goes down really to change management and perceived value. Without getting users on board, you're going to be hard pressed to make any progress. So you have to do that with training, 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 and training. And the second piece of the puzzle is really ensuring that you're able to provide the value to your users. So you're going to need quantifiable and empirical data that shows how implementing and embracing this type of technology is going to help them do their job.
That's really important. And listeners, you can find out more at icemortgagetechnology.com. James, welcome back to the podcast.
Hey, good to be back, Sarah.
Great to have you on. I want to jump right in because we have so many things to talk about. Let's start off with Homepoint. So last week we had some big news on Homepoint. What happened?
Yeah, well, a number of different things happened. Depending on one's perspective, it could be that, Homepoint sort of reemerges as a leaner, meaner lender in a year or two, maybe 3 years. Nobody really knows. But what we do know definitively is that an agreement has been entered for Homepoint to sell its originations business. Remember, they're only in the wholesale channel at this stage, to a company I'd never heard of until the day I wrote the story up. And this is on Friday, and it's called The Loan Store. And they're, a shop based out of Arizona. They've been around for a couple of years, but they don't do a lot of business. They are very under the radar. And, it's going to be between 50 and 100 people from Homepoint's originations business joining the Loan Store. And, they've already taken Homepoint's membership at AIM, which is, of course, one of the big broker advocacy trade groups. And it's going to be headed by Phil Shoemaker, who is the president of originations at Homepoint. He's been around the industry for a long time. He was at Caliber before Homepoint, and he's going to be really running the show. And, a lot of this really comes down to, one, Homepoint is a relatively new player in mortgage, and what we've seen across the industry, not just in mortgage, but in real estate in general, is you don't have to be a brand that's been around for 40, 50, 100 years, to really make a name and to really start to gain market share. Compass has been around for 12 years. eXp Realty has been around for just a couple of years, and, Better.com, not exactly a smashing success, but, in 2020, 2021, it was one of the top 25 lenders in America. You still can absolutely make up ground against kind of the bigger, more entrenched players if you have a good tech stack, if you have a good operations team, if you have a good product, and you're able to seize the opportunities that are there. I think for Homepoint, what happened was, I think they tried to out UWM, and that's a really, really tough task, and they couldn't really pull it off, and so I think when everybody was doing well, Homepoint was doing well. They were a top 15 lender in America in 2020 and 2021. They were still doing okay in 2022, but really starting in, I guess it was the spring, we started to see the cracks. And that's not exclusive of Homepoint. The mortgage rate increase, the difficulties of operating a business when you have a lot of mouths to feed and a lot of business coming in, is really hard to pull off, right? And so this is not a slight against Homepoint. I think, a lot of people thought they were really, really good operators. They had good customer service. They treated their broker partners pretty well. But for a lot of the brokers in the industry, they were always, Homepoint is my second option. If I have a loan, I'm going to bring it to UWM, or I'll bring it to Rocket, or I'll bring it to, whatever their favorite was. And Homepoint didn't really separate themselves from the others, in terms of offering either incredible service, right? Like real bespoke, white glove, or the best rates in town, or programs that nobody else had that, really gave them an edge in say non-QM or, something else. They were, for the most part, like a standard shop, right? And there are plenty of them. There are quite a few of them in wholesale, fewer today, but they didn't really differentiate themselves. And when UWM got serious, I mean, really serious, and started cutting their margins and saying, if you think you can compete with us, compete with us. But nobody can originate a loan as cheaply as UWM. They have a whole system that they've been building for years. They have their own technology. They can move a little bit more quickly. Homepoint, they did white label. Their technology was fine, but it wasn't something where you can compete with UWM on, you know, the cost of obtaining a lead or the cost of originating a mortgage. And so I think in the end, they just kind of got out muscled, and they never really had the cash position to go toe to toe with. At this stage now, we only really have two big players in wholesale, and the whole value proposition for wholesale is like, hey, I'm a broker. I can bring you, a huge amount of options. I can bring you the best deals, the best rates. That's what makes us special. That's why, we're here, and we're not these, yesteryear retail lenders that have bloated cost structures and, all these, mid-level managers they need to pay. Like we're able to do the loan and do it quicker than anybody and cheaper. That I don't know if you can say that anymore about wholesale.
Well, and I
And that's a
mean,
problem.
that is a problem. And we've talked about for months, maybe even a whole year, that, this was part of UWM's playbook. I mean, the reason they were absolutely looking to cull the field of anybody who couldn't keep up with their rates. And really that's a lot of people. So when you say that you felt like Homepoint kind of trying to out UWM, what do you mean by that? Like, what were they trying to do?
They went entirely in on the broker channel. At one point they had correspondent. They never did retail, but they had a few other lines. They had servicing. They decided we're not going to do that anymore. They really started to streamline their operations and to really try to get as many brokers as possible. And much like UWM, they were heavily affiliated with AIM. They were very much in the we are your friend. We are your, partner to the brokers, but the brokers can only send that one loan to one place, and so in terms of their products were not much different from UWM. Their service, some people definitely liked their account executives, AAEs, more than UWM, but they couldn't give you the best price. They couldn't give you the best service. They couldn't give you the tightest closing times. And so they went all in on wholesale. But in the end, they also had a lot of troubles operationally, especially toward the end. And I've written about this a couple times, but when any large or even small or medium-sized organization institutes a series of big cuts, there are going to be challenges associated with that, so you have to decide, which underwriters do I keep? Which processors do I keep? Do I need, these marketing coordinators? Do I need these loan officer assistants? Okay, let's say I decide to cut 75% of them. Well, which ones? Do I keep a couple that have institutional knowledge and can work on any product? Or do I say, I'm going to lean on my training and development programs and hope for the best and save money? But you have to get down to much lower levels of cost. And if you keep expensive underwriters and processors and others who know their stuff, you can't do that because you don't have enough business coming in. On the other hand, if you cut too many good and experienced people who know how to make the process work, then you run the risk of alienating those broker partners that you need to send business to. And not only do you need them to send you business, you should be their primary, not their secondary mortgage option. And so Homepoint never became the primary for enough mortgage brokers to overcome, just the pricing issues that they couldn't keep up with on UWM, having to sell MSRs and other segments of their business that could have been, revenue streams as well. And so it just, in the end, they just couldn't keep up. And at a certain point, you have to look around and say, what are we in business for? We're in business to make money. Like that's what a business fundamentally is. And if you cannot make money and you can't do it for multiple quarters, it's just a matter of when, right? And so the assets of Homepoint's origination business are being sold to this company that hardly anyone had ever heard of, did a couple $100 million in business, the prior year. And I think of mortgage originators that do under $1 billion is pretty small. So when we're getting into like the 300 million range, I mean, there are brokers unto themselves who do that much business or more in a year, right? So this really is a nascent operation. And Homepoint Capital, the parent company of Homepoint, the former originator, is basically going to be an MSR shop, right? So they have about 90 billion in MSRs, and they don't really do anything else. Like there are no other assets. There is nothing left at Homepoint. And so it's also interesting though, because Homepoint's exit for practical purposes could be good for the broker space. Homepoint as an entity was weighed down by a lot of debt. Homepoint, the entity, had just a lot of heavy cost structures. Even if you do cut, 4,000 people down to 800, but your business can only support 400, right? Which is probably we're honestly out. But still 400 too many, right? So if you then think of it again, like purely from a business standpoint, there are a lot of people who are losing jobs, and that's sad. That's disappointing. You would have hoped for better. But if you think of it maybe as a mortgage phoenix with 100 people, you could really get your rates at a better place. You can offer, products that maybe will work better in this marketplace, that you don't have to shift, so much of your operational, workforce around on. And it's kind of a wide open game in wholesale when you forget about the names UWM and Rocket. Could you tell me who the fourth biggest wholesaler is? No,
I
and
could
most
not.
people can't, because it doesn't really matter. There's no one. It's like it's so far down the list, and if you think about the bigger players in that are active in the space, but not really, from my vantage, trying to compete with UWM or Rocket. You've got the Calibers, you've got PennyMac is in there, you've got a couple others, but that's not where they're trying to dominate. They're not trying to go toe to toe with Matt Ishbia or Dan Gilbert, or to some extent even at Homepoint, and so I think there very much exists a possibility that the loan store gets it right. They offer a compelling product to brokers who, really could benefit from choice right about now, and then in a year or two, no reason to think that they couldn't be the third biggest wholesaler again, right? So it's a really interesting, wide open space, but I still worry about sort of those larger existential questions about what wholesale now represents if you really only have two players that are doing significant volume in that channel. So it's going to be an interesting time, but I don't think it's good news for the wholesale space at all.
No, I think you made a lot of really good points. One of them is, and this is throughout the industry, when you make all those cuts, you have to decide what is the fundamental level of business that we have to have, right? So, I mean, maybe we need to cut all these people, but then who's doing this very important job, or now they're doing two very important jobs, and obviously, customer service could suffer, but also compliance.
Yeah, and you need to keep compliance, otherwise, mortgage lender is not much good if the CFPB is answering the phones, right? So, yeah, it's you need a certain number of talented, experienced people, and that's why you can never fully cut your costs at a mortgage lender, because it's too regulated an industry, right? Like there's just no way. And I think that's why you see so many of these companies struggling, because you get down to it and you think, okay, if I need to cut 50% more of my staff, I'm looking around, they're like, 13 processors left. There are a handful of underwriters. There's, maybe a few in post-closing, and then it's compliance and legal and executives. And what are we going to cut? Like our executive vice president of production? Like, no, we're not going to do that. Are we going to cut our head of HR? No, we're not going to do that. Okay, let's say we cut an underwriter. All right, well, now we're going to struggle with non-QM products, or, okay, we cut some of the processors. All right, then do we run into operational issues in terms of getting the loans, in a good spot without cures, or, somebody not knowing where things are, right? It's not easy. Like, there is a reason that we're seeing a fair amount of consolidation and companies just saying, okay, well, we'll see you next cycle, right?
It would be fascinating to look at this Homepoint new rebrand, this whole new company, and see what happens. To your point, this could be the phoenix rising from the ashes, and we know that happens in this kind of market.
Yeah, and also, I spoke with a mortgage CEO, unrelated, operates in a few different channels, mid-sized lender. I spoke with him the other day, and he was telling me, one of the things that they wanted to do when they were looking at having to make cuts, and literally every single mortgage lender in America has had to make cuts of some level. UWM will say they're not layoffs, and that's fine, but their headcount is down, thousands of people. So, however you get to it, right? And so the CEO was telling me what they wanted to do is they wanted to get down to a benchmark level of having their non-sales payroll to be 25% of their revenue. And so if it's between 25 and 30%, they'd institute a hiring freeze. If it's over 30%, they would, of course, freeze hiring, right? Like, hiring is not going to happen when you're at that stage. But then they would also look at, where in the organization do we have too many people? And then that kind of gave them an operating principle to figure out, okay, how do we get much more efficient, and how do we do so quickly? Because keep in mind, when you do have to offer severance and you have to make, restructurings, it takes a couple quarters to really fully bake, and for the costs to also start to level out a little bit. Like, if you decide to lay off 100 people tomorrow, that's still going to show up in your books for the next 2 quarters. And so, we're kind of at a tail end of things, and for some lenders, but we're still very much in the middle for others. And Homepoint they made probably a dozen layoffs over, a couple years, really, from probably 2021. They did a big restructuring in the summer, and they did it all the way up through January of this year. And then, the final number is going to be like 60 to 100 people that are going to end up at this new company, right? So, it's to go from 4,000 plus people over the course of just a couple years, but still be doing business and still be doing, I know it doesn't sound like much, but in the fourth quarter, they did over $1 billion in mortgages. Like, it still requires personnel, like, it still requires know-how. And so when you think about how they do it at an even bigger shop, like Guaranteed Rate or a Rocket or a Loan Depot, it's really difficult. And the vast majority of them end up getting consultants, and they really struggle with restructurings, because when you try to figure out how to, remove the organs and put them back in at a company, with 10,000 people, in some cases, it's really hard. It's really, really hard. And you might not lay off the right people.
Well, and this is a purchase market. So this is more technical. It's more difficult. We're not talking refis where you can just bring someone in and be like, hey, let me give you some training. You can do this refi. This is, and you don't want to lose any of these loans. You need every single one of these loans to go through.
Yep. And a lot of these companies that did cuts are losing market share. And that's because on the sales side, a lot of their top performers are leaving because their pipelines are not full anyway. And they can still, depending on who they are and their production level, they can still get good bonuses and, find a new home somewhere, right? So you're also seeing kind of the bleeding effect of that, elsewhere. But it's also, I think, important to note that we're not seeing problems with, underwriting issues. We're not seeing problems, at least structurally, with how the industry is able to originate a loan. And so even though a huge number of processors and underwriters and, kind of the back office staff have been cut, I've spoken to a number of top level executives at big medium and small firms that have done restructurings, and they say they really haven't missed a beat. And not to sound callous, but a lot of them say, I wish I had done this sooner. I wish I had done more sooner, and we would be in a much better spot, because now we start to lose a little bit of market share as the months go by. And it's just really interesting. It's so much of this market now for these originators is keeping your sales pros. And it's not about how many processors you have or the, underwriters on staff either.
Well, and they were sort of in an arms race where no one wanted to be the first one to start laying off. We knew that there was oversupply coming off the refi boom. We didn't see people really react fast enough. And one of the things is they felt pressure, like, if I do that, I'm going to lose all my top people. They're going to see the writing on the wall. And so no one wanted to be the first, and no one wanted to do it too aggressively, but you can see how that didn't end up great.
And do you remember who was the first?
I don't.
Better.com. And the way they did it, of course, is now, it lives in infamy. And so maybe that scared a couple to be like, you know what, I'm going to wait until after the holidays to mass lay off hundreds of people on a Zoom call and then call them, all kinds of things I shouldn't call them. So yeah, it's
that's a great point. I've forgotten about that. Yeah, maybe the backlash of that, just everyone was like, you know what, I'm just going to wait. I don't want to be the next person after that. Although if you did a layoff after that and did it in any sort of, normal way, you'd be looking good, because people were like, well, at least it wasn't, 900 people on a Zoom call.
Yeah. But if you talk to the experts, the people who study production and kind of the health of the independent mortgage banks, and I touched on this last week in the podcast with Bill Conroy, they say we still need to cut about 50% of the workforce in the mortgage industry.
Wow. How is that possible?
Well, okay. So that now, obviously not everybody has the same position, but there are a huge number of loan officers who are doing, let's say, 2-3 loans a month in the good days. And now probably tens of thousands of them don't have any loans in their pipeline, who are averaging less than a loan a month. And that's not just the, by and large, the inexperienced loan officers who maybe got into it in 2020, 2021 and rode the refi wave and hoped to build up their Rolodex and get in with real estate agents. It also includes a lot of veterans. And a lot of them, I mean, maybe I'm wired a little bit differently, but I can understand if you did $1 million, you gained $1 million in 2020 and then another 1.2 million in 2021, and then let's say you drop down to 500,000 in 2022, looking around in 2023 and saying, you know what, I don't want to make 50 calls today. I don't want to go to that open house. I don't want to do this. I don't want to do that. And generally speaking, this is a workforce that trends a little bit older. Average LO's a guy in his 50s. If you made good money through various cycles, maybe you want to, hang up the cleats or the, I don't know.
Loafers?
What apparel. Yeah, I guess penny loafers probably right.
Okay, so we had a really interesting thing happen over the weekend about a story that we reported even a month ago. So tell us what happened and the misinformation that we saw coming around.
This one really annoys me for a number of reasons. But okay, so last month, the FHA announced a final rule that allows mortgagees to increase the maximum FHA insured mortgage loan modification term from basically 30 years, right, 360 months, to 480 months, 40 years, following a default. And so that change is slated to go into effect on May 8th. We reported this correctly. A number of the industry trade publications reported this correctly. This is all related to the loss mitigation initiatives by the federal government, and the FHA is not the only one. But for whatever reason, last week, I don't know if it was from local TV networks or if it started on the internet, but there is content that surfaces on TikTok, on Facebook, on Instagram, and other places saying that the FHA has just announced a new 40-year purchase mortgage program. And these influencers and other people start going on about, all the benefits to stretching out the term, lower monthly payments to whatever. And you see a lot of like hustle bros and, influencer types talking about how big this could be. This is one of the biggest game changers in mortgage in the last decade. The problem, it's total crap. It's literally not true. This is purely a program for existing FHA borrowers who have declared default. Right. This is not a purchase mortgage program. This is like about as far away from a purchase mortgage program as you could get. There is no 40-year purchase mortgage program in America, whether it's conventional, whether it's, through Fannie, Freddie, Ginnie, whatever. It does not exist. There may be 40-year, private mortgage loans out there. But if it does happen, it's extremely rare. So I'm trying to figure out where this all started. Is it because, a TV news reporter who was not a business journalist, who, could very easily get lost in the jargon of government press releases, see something on TikTok, all these influencers talking about blah, 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 and then he or she writes it up, and then, suddenly that gives it validity. People say, oh, well, the news reported this is happening. And so that means, I should, and here's the worst part of it though. The people who spread this are like, claim to be real estate agents. They claim to be mortgage brokers. They claim to be, financial advisors. I don't know the credentials of these people. It's not, it's not something that I've looked at yet, but if they are, I mean, that's shameful. That's really, really awful.
I think that's the part that we were like, what? So first of all, we were trying to look at like, where did this originate? And Yahoo Finance, I think, carried it, but it was really, like you said, it was a story that a local news show, when you look back at what they did, it was an affiliate on TV.
Yeah, it's like an ABC affiliate in Arizona or Kansas or something.
And so they went with that headline. And to your point, though, anybody who's in the industry, how in the world were they fooled by that? And we were inundated. Like, we looked and it was just crazy how many. We're not talking, a couple of stories. It was just like a tidal wave. And it happened all of a sudden over the weekend where, to your point, these are real estate agents. These are LOs. These are, some of them, we can tell who they are. Some of them, who knows why they're doing that. But it was crazy.
And I think it was just a bad mix of people who should know better and get maybe excited and caught up. And maybe it's part of this, cultural expectation in the industry that you need to be posting content every day. And, maybe people get carried away or they're just, they lack media literacy, which is very normal. But if you're a real estate agent and you're like using ABC 15 in Scottsdale, Arizona as your source for, product information on mortgages, like, I wouldn't want to be your client. Like, that's a big problem, right? I mean, geez. So yeah, that's the issue. And then, just kind of the larger problem that I have with all of this is how easy it is for simple misinformation to spread. I have people who are, mortgage loan officers who've been doing this for decades, who know product, who know compliance, like who know, TRID and, all the acronyms like the back of their hand. And I occasionally receive emails from them saying, hey, we saw this misinformation about, I've seen one about temporary rate buy downs, like people saying that, they're permanent. Like, you just have to pay, well, it's like, okay, there are two different things, right? A temporary rate buy down is a 1, 2, 3, right? And that's separate from buying points, at the beginning of the process. And so often it's real estate agents who probably just don't know the product as well as they should. A real estate agent should know mortgage products, maybe not as well as a loan officer, but way more than the average consumer, right? Like way more. And you should be able to spot this a million miles away. I mean, if the FHA came out with a 40-year purchase mortgage, there would be so many articles from us, from, other business trade publications. You'd see it in Bloomberg, you'd see it in the Wall Street Journal. It wouldn't be leading like ABC 15 Scottsdale, like, use your noggin, right? I remember when the FHA cut MIP, right? The insurance premiums. That was huge news. Absolutely huge news. There was also a ton of misinformation about that, right? And so I think maybe this is just a reality that we're going to have to accept in the advent of the internet, in that people claim expertise. There's no way to credential people in some settings, and just the algorithmic approach means these things spread like wildfire because people want to believe, and we are wired, socially, psychologically, to want to believe, that these things that may benefit us, or maybe just are interesting, or scary, right? In the opposite context, are happening, and so often they're not.
So the takeaway here is that our audience should be reading you and your newsroom and HousingWire Real Trends Reverse Mortgage Daily, because we hire credentialed journalists. These are people who, come from great programs, and they're accountable for what they write. So that's our takeaway. I know it is sort of self-serving, but also it was so crazy to see that this weekend and think about all the people who were like, this is great. And I mean, people were so excited. You also had some people who were like, wait, there shouldn't be a 40-year mortgage. Like that's a terrible idea, whatever. But most people, it was something that they were latching onto because it was like, this is the way we get millennials into homes. This is the way first-time home buyers can afford this market. So it was just sad to see like all that misinformation going around. So thank you, James, for what you guys do. And thanks for being on today.
Cool. Thanks for having me, Sarah.